Hi there, my name is Andrew Macken and welcome to this week's edition of Video Insight. There has only been one story in global financial markets over the last month, and that has been the collapse of the price of oil. Crude oil has fallen by about 25% over the last month and by nearly 50% over the last 6 months. The sharp falls have primarily stemmed from the news that oil cartel OPEC would not cut its production in light of falling oil prices. Today we will not focus so much on why OPEC has chosen to take this course of action, but rather what the impacts might be of sharply lower oil prices. First, on a positive note, consumers will experience a boost in disposable incomes as their cost of living decreases, and this will likely boost the retail sectors of the economy as well. In the US, for example, we've already seen petrol prices fall to nearly 4-year lows, and retail sales growth has really strengthened recently. Similarly, industrial corporates will too benefit from reduced input costs. This is all good news. On the other hand, new oil-related investment will all but grind to a halt. The shale investment boom in the US has been a key driver of the nation's recent economic growth and employment. Similarly, future new investment in Australia's LNG sector that relies on oil-linked gas contracts will also likely grind to a halt. This will create a serious drag on these economies at a time when growth has been difficult to come by. Lower oil prices could trigger a repricing of risk in certain credit markets. Much of the US shale sector has been funded by the high-yield debt markets. Most agree that high-yield markets have been in bubble territory for some time now. Lower oil prices raise the very real prospect of credit losses as capital structures need to be reorganised. It's difficult to know if this will be an orderly or disorderly process and what the potential knock-on effects to equity markets might be. Finally, there is a monetary impact as well. Central banks around the world have been bending over backwards trying to create inflation. They have not been successful to date. For instance, did you know that market-implied inflation expectations are at 4-year lows in the US, and this is despite nearly 5 years of quantitative easing? Low oil prices will have a deflationary effect on every nation in the world. Does this mean more quantitative easing? It probably does in some parts of the world. That's all we have time for today, and don't forget to follow us on Facebook and Twitter.